Welcome to Health Alert. I'm Pam Butler. Today we're going to talk about financial health, looking at mortgages, and joining me is Stefan Chappell. He's with the AMC Mortgage Group. He is the branch manager and also the Chappell team. Welcome to the program.
Thank you very much for having me.
Now, this is really something important that we all need to know in terms of our financial health, looking at mortgages.
Yes.
I want to start by asking you, several years ago there was a big mortgage crisis or bust, or sort of refresh our memory. What was that all about?
Well, basically what you have is a huge change in the market insofar as the availability of loans, mortgages. A lot of new products came to the market with lots of different types of guidelines that were not as stringent as the years previous. As a result, what you had was a lot of people enter the mortgage market. You had a lot of new loan originators, loan officers enter the mortgage market, and the desire to get as many people into homes as possible is what really fueled what eventually turned into a bust. There were a lot of people actually weren't prepared. There were a lot of underwriting guidelines that had become laxed, very liberal and not as conservative, and that actually adversely affected the market. So that's really what kind of precipitated into that.
Okay, was that a situation, the way you're describing it, where people who really didn't really qualify for loans were able to get them? And if so, who was profiting?
Well, it was really, what it was the different loan products that came to market, whether it was investment firms that were underwriting these or structuring these products. Because they were so liberal in their underwriting guidelines, the matrices for determining whether or not someone's approved, and because there was such a desire for loan officers to get loans closed, get people in the homes, it turned into an issue where you had individuals who really were not prepared.
Okay, they weren't qualified, really.
Exactly. And so, although they were for those types of loan products.
Right, but truly.
Exactly. The real issue was with regards to the longevity and, what's going to happen 18 months, 24 months past getting that loan. I don't really think a lot of consideration was given for a lot of loan officers and borrowers. And the profit really was for basically everybody in the process, unfortunately.
Okay, except the homeowner.
In some cases, and this is really where it can be kind of paradoxical. In some cases, the homeowner was part of the collusion. They truly were. There were a lot of homeowners I know I work with personally who I made it quite clear to them. Although you're able to get approved for a loan, the loan products that you're able to approve for are not the best loans for you. There are some issues such as adjustable rate mortgages and different loan types that many of these borrowers, they just simply were not prepared to obtain, and they didn't understand the products. And I can't deny someone who can approve, but for me it was, you really want to give some thought to this. I had several borrowers who left and went to other loan companies who were more than willing to get the loan done. And I know, unfortunately, many of those borrowers who today no longer own those homes. Okay,
so they profited in terms of getting the home, but they didn't profit because they lost the home.
Overall, exactly.
Okay. Now, I want to ask you, switch to the different kinds of mortgages that are out there. And eventually we're going to talk about first-time buyers and people that are re-entering the market, what they need to know. Help me understand the different kinds of mortgages. You talked about the adjustable rate. Is that like the balloon? We hear about the 15-year. We hear about the 30-year. There's all of these mortgages. Kind of break them down for me.
Well, you have different mortgage types. You have your government loans. You have USDA, United States Department of Agriculture, your rural development loans. You have your FHA loan. You have VA loans. You have what's called conventional loans, which are based on two government enterprises, Fannie Mae and Freddie Mac. Those are conventional loans. And within those loan products, there are fixed rate loans, 15, 30-year, 20-year loans. There are adjustable rate loans that can go from 3, 5, 7, or 10 years fixed, and then the rates adjust. And so it's not really, each of those mortgage types may have different loan terms. And I can't say that any of the loan terms, whether it be an adjustable rate mortgage or a fixed rate mortgage, are bad loans. I think every loan is a good loan, but every loan is not good for everybody.
Okay, well then how do you kind of decide what is going to be best for you? I mean, looking at the adjustable rate or fixed, or how do you go about as the person seeking the loan, knowing what you need to go for?
I believe that starts with the loan officer.
Okay.
I believe it's important, and many loan officers in the industry, they're good troubleshooters. One of the very first things we need to do as mortgage professionals is listen.
Okay.
To understand what is it the borrower is trying to accomplish. So that way we can determine, based on what they're trying to accomplish, what loan product would be the best product for them.
Okay. Now, if I came to you and I said, okay, let's say I'm wanting a house that has 4 or 5 bedrooms, 2 or 3 baths, four garages. I mean, do you, and you look at my income, don't you? I mean, how do you help me determine whether what I'm asking for is a bit beyond where I need to really be?
Exactly, and that's why it starts with listening to see what it is you're trying to accomplish. And I mean, as a troubleshooter, and every good loan officer is a troubleshooter, what you do is determine if what your desire is lines up with what your credit profile is, your ability to be able to pay back that mortgage is, and all of that's based off of obtaining your personal documentation, your taxes, your pay stubs, bank statements to show available funds to close a loan. Once we get that information, that's more than what's called a pre-qualification. We're able to approve you. We're able to know for sure if you can qualify for the type of home you're looking at. And one of the things I know many mortgage professionals stress to borrowers is, come to us first.
Okay.
You know, so many borrowers will go look at the house.
Right.
And then they'll come to a mortgage professional. And that's actually the opposite. They need to start with us because we'll help them to determine what it is they're able to afford.
Okay, and therefore you can go look at what's within that range
Exactly.
of feasibility and being realistic.
Right, exactly. And that's one of the things I believe during what led up to the mortgage crisis didn't happen. It was simply, this is what I want, I'm going to do everything I can to get it for you.
Okay.
And that solution was actually a non-solution. That actually created a huge problem, because so often as borrowers, we know what it is we want, but we have to make sure as mortgage professionals what it is you want lines up with what you can actually accomplish, because we have to protect the investors who we are providing those funds to the borrower for.
Now, let me ask this question about like balloon loans. Are balloon loans the adjustable rate loans? Is that the same terminology or two different things?
Basically, what a balloon is on a mortgage is the way the loan is set up is, after so many years, that mortgage is going to need to be, perhaps it may have a fixed term. After maybe let's say 5 years or 15 years, that mortgage is either going to have to be paid in full, or it will need to be refinanced. And so, you know, at that point, the borrower will need to determine if they want to go ahead and pay the loan in full, or they want to refinance it. And the benefit of that type of mortgage for the borrower that loan benefits is often they have better rates. They have more favorable rates. The downside of that for a borrower who fails to understand, and the mortgage professional, that this may not be the loan for this individual based on what they've shared with me. They plan on being in the home a long period of time. That may not be the best loan for them.
Okay, so it sounds like a balloon loan could be advantageous if you're going to do it on a short-term basis, live in that residence. So maybe you will have sold it or moved on before, if you don't refinance, before the higher interest rate kicks in.
That, and the other, there are several facets. Some may be there's going to be an increase in pay.
Okay.
Perhaps there's a promotion, you know, that's coming. There's an advancement in, you know, there's an addition to the home. And so there's going to be changes that are going to take place, and the funds are there to accommodate that. The initial loan was done that was going to benefit the borrower at that time. And they understand, because the mortgage professional has made it clear that, you know, ultimately you're going to need to refinance this, and you need to be prepared for that because of the balloon feature.
Or bail out in time.
Exactly, or get ready to sell.
Okay, we're going to take a really quick break and come back and talk about first-time buyers and what they need to know and be aware of. Okay? Please stay with us. We'll be right back.
Turning a 20-foot wall into a canvas takes vision. So will getting into college. I've got what it takes. So do you.
Clean kitchen surfaces, utensils, and hands with soapy water. 1 in 6 Americans will get sick from food poisoning this year. Keep your family safer. Check your steps at foodsafety.gov.
So, I got this new family. And I don't know what it is about this one, but she can't seem to put down that toy. Oh, and she even talks to it. Who's she talking to? Her mom? She talks to her mom a lot.
Welcome back to continue our discussion focusing on financial health with mortgages. Joining me again is Stefan Chappell. He's with the AMC Mortgage. He's the bank manager, and he's also with the Chappell team. Let's jump in. Now, first-time buyers. How do they start? We've already talked about in the first segment going to a mortgage professional and sort of talking about what you are looking for, providing some financial information. Tell me more about that.
I enjoy working with first-time home buyers because so often they are terrified. They don't know where to start the process. And for most first-time home buyers who have not seen their credit, they don't really know what's in their credit profile, I highly recommend to start again with the mortgage professional, or there are housing counselors. We have nonprofit agencies right here in Tulsa. We have the Metropolitan Tulsa Urban League. We have the Tulsa Housing Authority, and we have Community Action Project. And those housing counselors are available through these nonprofit agencies. That's what they do. For the first-time home buyer who perhaps can income qualify, there's also the opportunity for down payment assistance. And so that's the best place for a first-time home buyer to start, so they can first determine what we're looking at in their credit profile, and from there, again, obtain the documentation we need to determine what they can do before they take out with their realtor.
Okay, and any community that you're in, you can look for these housing professionals to be assistive to you as well.
Exactly. Yeah.
Okay.
The housing counselors are available, and they actually encourage first-time home buyers, even if they're not able to income qualify. I know specifically the Metropolitan Tulsa Urban League and the Tulsa Housing Authority, they still want these first-time home buyers to attend their seminars. I mean, they go over credit, they go over the loan application, they'll have a real estate agent available, perhaps mortgage insurance or hazard insurance, homeowners insurance agent, to understand what's all involved with that mortgage process.
Okay, now let me ask this question, because you talked about credit a couple of times. Tell me a little bit more about credit. I mean, we've seen the commercials with the 3 guys, and the one guy has the 500 and the other 2 got the 700. Tell me about credit. I mean, what do these numbers mean?
Well, basically, when borrowers apply for credit, there's different types of credit. You have utility loans that if they're not paid, oftentimes they may hit a credit score. But typically what we're looking at in the mortgage market are revolving accounts, are installment accounts, credit cards, auto loans, installment accounts, basically to see the payment history of those individuals who are applying for mortgages. The credit score is determined by the risk associated with those accounts. And that information is obtained through Fair Isaac.
Okay.
It's called your FICO, or the scores are called FICO scores. The other issue is, you'd mentioned the commercial. A consumer credit pool is going to be different from a consumer who's applying for some sort of a credit product, whether it be a mortgage or auto loan. And the reason is the information that we obtain is going to be based on templates through like Fair Isaac that are going to determine your ability to pay a mortgage or some sort of an obligation back over a longer period of time.
Okay.
And I've had many borrowers who have come to me with their scores that they've purchased from one of these companies, and they're usually anywhere from 20 to 50 points lower when we pull credit for a mortgage, what's called a mortgage credit report, when we pull that, as opposed to a consumer pulling their own.
Okay, now when you talk about the different places you can pull them from, is that Experian and those places that we've heard of, that there are 3 entities that you can go to check your credit?
Those are the bureaus. Those are the repositories that information will be who will be gathering the information on each particular borrower. However, you have so many different places now that will tell you they can pull your score. My personal suggestion for any borrower is start with the housing counselor. Or if you know you're ready, you feel pretty good about your credit history and how you have handled your credit in the past, you can go ahead and move to a loan officer. The reason for that is the scores that a housing counselor at any one of the nonprofit agencies will pull and our scores, they should match.
Okay, now with this, I do want to get back to this though, because you are supposed to be able to get one free report. You don't really have to pay these entities to go pull your credit.
Exactly.
And people need to realize that. You can once a year contact those 3 areas and ask them for your credit scores.
That's correct.
And look at your credit information and then dispute anything that's not correct.
That's correct.
So people need to know that as well. But that is a good place for people to go and to keep abreast of what their credit is looking like, correct?
That's correct. And the annualcreditreport.com, it's all one word, annualcreditreport.com. That's typically who I would suggest borrowers visit their website. They can obtain their own personal credit report. There's no need to get the scores because they're not going to work for a mortgage professional when that borrower is ready to apply for a mortgage, an auto loan, or anything else. We're going to still have to pull our own credit report.
Right, but it just gives you an idea of how you're faring, kind of a thing,
Exactly.
at that time.
Right. The other one is the whole issue with credit repair. You'd mentioned being able to remove something on a credit report
Right.
that maybe shouldn't be there. Again, the nonprofit agencies, these housing counselors, they do that at no cost. And I know many borrowers who have, unbeknownst to them, went to a credit repair company and paid to have something done that they can have
That
done
they
free.
could do for free.
Exactly.
Now let me ask another question with this. What kinds of things can negatively affect your credit? Like you talked about looking at the revolving accounts and payment history. If you're 30 days late, does that negatively impact you? If you're 30 days late once a year, every month, I mean, what kinds of things can impact that?
Yeah, that's a good question. One of the best places to obtain the information on exactly how many different things can adversely affect your credit would be myfico.com. They have an educational link within their website that's very easy to follow, and items like late pays, too much credit, the usage of credit. In other words, perhaps if you have a $1,000 line of credit, your balance remains, monthly at around $900. That actually can adversely affect your score, even if you pay every month on time. Judgments, tax liens, of course, bankruptcies, whether it be a Chapter 7, Chapter 11, or Chapter 13. Late paying on utility bills. Oftentimes, your utility companies, when you either go into a collection or you're in default, they will post that information to the credit bureaus. Okay,
let me ask this question of you. What about if you pay off all your credit cards, should you close those accounts totally or leave them reflecting on your credit history, although it's a zero balance? I mean, we hear back and forth, close them. Some say, no, don't. It could mess up your credit or it could affect it. What?
That's a good question. And for every case that I've had where that was the case, borrowers asking that question, my answer is it depends on what that borrower is getting ready to do. Again, if they are borrowing and they're getting ready, for example, to apply for a mortgage, my suggestion is simply leave it alone. Whether it be consolidate student loans, whether it be pay off an automobile. And the reason is items like student loans. For example, you may decide to consolidate several student loans into one student loan. That can actually adversely impact your score. Closing credit accounts that they've had positive history up, the entire time you've had that account out there, and you decide to close that account, well, that's not going to be able to score in any longer. Let's say, for example, if you have any adverse credit accounts, and so now you've actually removed one good account that was helping score in your favor, And you still have the bad accounts that perhaps can stay on your credit for anywhere from 7 to 10 years.
Wow. Okay. Well,
Many borrowers are not aware of that, and that affects
No.
borrowers because what they think they're doing is a good thing, paying
Right.
off items, consolidating items. But because of the way the scoring is, what merchants want to know is, are you able to pay on time over a period of time as agreed? And when that information is not there to grade in that factor, all that's able to be graded is any remaining accounts and any adverse accounts.
okay. Well, we're going to take a really quick break and come back and look at what people need to know if you've been in the market, but you're trying to, and you've been out of the market and you want to re-enter to try to purchase a home. So stay put, and you stay put. We'll be right back.
The forest is a magical place for your whole family, with animals and fun all around. So discover the forest and explore all the wonder that's there. Visit discovertheforest.org to find a forest near you.
Welcome back. To complete our discussion talking about financial health and mortgages, joining me again is Stefan Chappell. He's with AMC Mortgage, and he is the bank manager, and he's also with the Chappell team. I'm so excited. I don't know what to do here. I've got this burning question I don't want to forget.
Okay.
When you were talking about, we were talking about and clarifying closing accounts and when you shouldn't and probably should do that and how it can affect credit. And you talked about consolidating loans. I want to ask you about, because you get these things in the mail all the time about the lower interest rates and balance transfers. Now, does that affect anything? Because that's kind of like a consolidation, but you kind of like just transferring it somewhere else for a lower credit, interest rate. Tell me, does that work?
That's a really good question, and that actually has a catch-22 because, again, if you're applying for credit, what you've just done, regardless of how much you had on that account that you're transferring that balance to, you are establishing a new line of credit. And some of the contractual agreements on those types of accounts is you have to close out the account that's being transferred from to the new account. And so what will happen in that case is you are actually opening up a new line of credit that is not going to score against you positively.
Okay.
And you are closing an account that, as long as you've had that account current, is now going to no longer exist to score in your favor. So it can
Okay.
actually lower your credit score. You've accomplished consolidation, lower
Right.
interest rate, and a better payment. But insofar as borrowing or a mortgage is concerned, you've actually worked against yourself.
Okay, so you really need to know the full details of that transfer, whether it's what it's really requiring you to do versus, oh, this is a lower interest rate. And then not doing it too often. I've often heard, too, that you shouldn't do these transfers too terribly often because that is a red flag.
Exactly. And again, for me, I cannot stress enough, whether it's an existing home buyer who perhaps is going to re-enter into the mortgage market, or it's a first-time home buyer, the best place to start is with your mortgage professional or with a housing counselor.
Okay.
Because they can make you aware of how whatever it is you are desiring to accomplish, in addition to obtaining a mortgage, how it's going to affect the mortgage.
And maybe before you do that, especially if you're doing it in preparation for the mortgage, before you do it, talk it out to see if that's a good thing.
Exactly, because there may be a lot of surprises as you're discovering. I mean, it really, that happens more times than you can ever imagine. For a borrower, they truly do have the best intention in what they're trying to accomplish, but it's actually going to work against the ability to obtain a mortgage.
Okay, now, if I am a person then who has been in the marketplace already, I have a home, but now I want to re-enter because I want to upgrade or downgrade or whatever. What are some additional things that I may need to be aware of? Because I know about giving you my check stubs, but what are some other things I should consider?
Many of the same requirements for a first-time home buyer are going to exist for an existing home buyer who is ready to re-enter the market for whatever the reason may be. Things like perhaps if they're going to sell their home, if they are going to rent their home out, those things are going to be important to understand how the guidelines for whatever mortgage they're going to be attaining, how those the choices they're going to make will affect their ability to be able to get the new mortgage. Selling a home, for example, we typically want to see, our underwriters want to see the settlement statement to show that that home has indeed sold.
Okay.
If that home is going to be rented out, you just simply can't find a tenant and draft up a contract. There's more involved to that process because the underwriters want to know and be assured that the profit that's going to be used, perhaps if there is a profit, that's going to work for you for the new mortgage is actually sound. I've had borrowers who they were going to rent their home out and they just simply did a contract with someone and it wasn't valid.
Okay. Yeah.
Only to discover there's a time limit that either that borrower must be in that property or we may not be able to utilize those funds that you will be getting as net rental profit.
Now let me ask this question because you talked about, okay, I already have a home. I plan to sell it, but it hasn't sold yet. Is that going to hamper my ability to get a mortgage for another home? I mean, do I have to wait till it sells?
Well, the issue there is, again, capacity. If you have the ability within your debt to income ratio to hold both mortgages within your debt to income ratio, then we can still approve the loan. But again, if it's the pending sale, we have to show what that existing mortgage payment is and what your proposed mortgage payment is until we have a settlement statement to show that that house is sold.
Okay, okay. And then another question too, you talked about the debt income ratio. About how much of my income should I look at putting on a mortgage? I mean, is it 50%? Is it about 20%? I mean, how do you look at it in general?
I'm much more comfortable with borrowers whose it stays around 31 to 36%. And their overall, we call it a front-end ratio and a back-end ratio. In other words, when you include all of the other obligations you have, automobiles, credit cards, and the such, may not exceed 45%. Because if you think about it, you still have your utility payments that are not factored into that mortgage. And so those numbers are just showing you what the items that are going to be on credit, on your credit report, and that proposed mortgage are. They don't include, the cost to live in that home, the utilities, grocery, gasoline for your automobile, those types of things.
Okay, one other quick question here before I have to wrap it up. Number of children or people living in your household, does that ever factor in?
For first-time home buyers, for example, to obtain down payment assistance, that can actually benefit them as far as their income qualifications.
Okay.
A rural development loan, that type of mortgage product, that can actually benefit them as well.
Okay, so talk about it. Thank you so much for joining me.
Thank you for having me.
Well, that's our show. For Health Alert, I'm Pam Butler. I'd love to hear your questions, comments, or suggestions for future shows. Please write me at Health Alert USA, P.O. Box 50913, Tulsa, Oklahoma 74150. Or if you're on the email trail, please email me at healthalertusa@gmail.com. And also visit me on YouTube at youtube.com/healthalertusa. And remember, talk to your mortgage provider in your community, look at those housing specialists, and get the free information and assistance that you need, because you don't have to pay when you don't need to pay. Take care.